Frank Napolitano is here from MortgageBrokersOttawa.com. We're getting ready for a big show next week. By the way, you can get tickets. The Kidney Foundation benefiting from a big fashion show we're in.
You and I were in a fashion show walking down the... Wow.
Yeah, hard to believe.
Interesting, yep.
Yeah. Fashionable to save money on your mortgage, and you can do it these days. You talk about those good rates you were here last time talking about. Still available, $299?
$299, 5-year fixed. Pretty incredible.
I'd do that at 5-year fixed.
Pretty incredible. You don't have to worry about anything for the next 5 years.
Yeah, now...
Free money, almost.
What does it mean, though, in real monetary terms? Well, you've actually broken it down because you had a couple come in and change things around for them, right?
Well, I got their mortgage 5 years ago, and 5 years ago, the 5-year mortgage rate was 5.74. So they came in, they sat down with me, they were all excited at the prospects of a lower payment. And I said, well, is the lower payment the most important thing you're looking for? No, we're actually excited, I guess, at the interest rate almost in half. And I said, that's great. Would you consider, like, is your lifestyle comfortable enough right now where you would consider keeping your payments the same? And they said, absolutely, we're very comfortable. We still do everything we want. I said, great, let's keep your payments the same and let's see what that results in. So they had a $275,000 mortgage in 2007.
Right.
Took out a 5-year mortgage. Back then, they had the 35-year amortization. We had the 35-year amortization. We don't have it anymore.
No.
Their biweekly payments were $754. So at the end of 5 years, their balance went from $275 down to $251.
After 5 years?
After 5 years. Not bad. They knocked off about $23,000, $24,000. But they had made $98,000 in payments, so $75,000 of it was interest in that initial 5-year period.
Oh, geez. That's early, though, right? That's early in the game.
That's the first 5 years. So, you know, their amortization went from 35 down to 28 because they were making accelerated biweekly payments. They got another 2 years off, which was good. So they're down to 28 years. What we did this time was we kept their payments the exact same. So now they're $251,000 that they have left over on their mortgage. What we did is we kept the payments the same. They got a 5-year 2.99, and now with that same $98,000 worth of payments they're making over the next 5 years, $33,000 of it is interest and $65,000 of it is principal. And what that means is their balance is down to $186. And the best part of it all, they went from 28, you take the 5 years, you would be down to 23. Keeping their payments the same, they're down to 12.5 years. They've knocked 10 years of mortgage payments off.
What?
The mortgage just by doing that.
And
10
still
years of mortgage
paying the
payments.
same.
And paying the same that they've been accustomed to. That's what the difference in interest rate does, and that's what happens when you get a lower interest rate like this. 12.5 years.
Now, they were at the end of their 5-year initial term.
They were at the end of their 5-year term.
Do you have to wait till then?
Not at all. There are customers that call us all the time, and they're at 4.5%, and we'll always give them the advice based on whether it makes financial sense to do it. So
but what if
I
go
the penalty is excessive
to
get out of it, then it may not be the right time to do it.
So... yeah, the penalty is one thing.
Penalty is a big thing because what you're doing is you're giving the bank the money up front, and that's and then you're paying interest on that interest as well. So by the time you put the compounding in there, it may or may not be worth it. Then again, some customers need it for cash flow purposes. You know, in this case, they were able to maintain the same payment because their lifestyle was comfortable. There are customers that come and see us and have other credit facilities that are much higher interest rate. So then we may lower the payment and have them put that extra money towards the more expensive debt so that they can pay those off and then tackle the mortgage once those debts are gone.
Which is beneficial as well. However, if you can knock years, like 10 years off your mortgage, even any amount of time off your mortgage and still pay the same.
Yep.
You're doing a good thing.
Absolutely. Absolutely. It's not much. Again, I mean, there's an example of 10 years. Think of $98,000 you pay in 5 years. So that's $200,000 less in payments.
And it's already something you're used to with your mortgage payment, unless you're struggling, like you say.
Exactly.
That's good advice. You can find out more. Just get in touch with Frank and his team, MortgageBrokersOttawa.com. It's good stuff.
Fantastic stuff.
And next Thursday, right, we're at Myers.
We are.
Myers.
Walking down the runway, fashion models.
Yeah. If you want more information on how to get tickets for that, get in touch with either one of us, and we'll make it happen.
Love to see you there.
$50.
Yep, that's it.
Got some food,
and drinks. Yep.
And Frank and I in fashions. I mean, wouldn't you pay $50 for that? Okay, no, we can't pay you $50. That's not the way it's going to work. There's a look at traffic coming in from west to east, headed toward downtown. Pretty busy up there, but nothing out of the ordinary. We'll be right back. News update next.
This Mortgage Minute brought to you by MortgageBrokersOttawa.com.